All right, friends, welcome to tonight's webinar. This is a very special financial education webinar, which we do monthly here at FTMDaily.com. This is the fundamentals of precious metals investing. What a hot topic this has been over the course of 2011. And, of course, if you go back to the last decade, as we're going to show you tonight, that gold and silver have just simply been hot. People are wanting to get involved with gold and silver. They're wanting to learn more. And that's exactly what this webinar is going to be about tonight, to talk about the good things and some of the pitfalls that you might want to be careful of in precious metals investing. Either way, I believe that at the end of this 90-minute webinar, you're going to be very empowered, and you'll certainly be educated, and you'll know a lot more about going forward with precious metals investing. I'm going to be joined tonight by my good friend and precious metals advisor, Tom Cloud, and a bit more about him in just a minute. Just real quickly, let me introduce myself. Those of you who may not know me, my name is Jerry Robinson. I'm the founder of FTMDaily.com. That is our website. We also have a company called Makers Group Financial, which is actually the parent company of FTM Daily. That's available at makersgroupfinancial.com. We don't really publicize that website too much. However, that's the parent company. That's the parent company that I own. And then FTMDaily.com is one of our websites. And I tell you what, I am really excited about all of the traction that we see as we're helping educate people on this topic. It's very, very timely right now. So anyway, there's enough about me. Let me tell you about my good friend and co-host today, Tom Cloud. He's a precious metals advisor. He's been in the business since 1977. Ain't that right, Tom?
That's correct.
Been focusing on gold and silver, bullion, and numismatic coins. He has just been in the business. Tell him a little bit about your background, Tom.
Well, I got into it at a young age. I was very fortunate, and in 1977, gold was 77 an ounce, and 3 years later it was 800. So I saw a parabolic rise. I started my career watching the parabolic rise in gold and silver. So the 600% move the last 10 years has not been a parabolic move. So, and then, but I spent the last 34 years in this industry and have waited for the market to come back around, and certainly have learned a lot over the years, and have been on many prestigious boards and over the years, and started slowing down about 6 years ago and started letting employees go, and next thing I knew, God had me back in this thing more wide open. And I really do think it is to help people, to make people aware of what's out there. They've worked hard for their money. They deserve to know what they're getting into and what to buy and what not to buy and what the pitfalls are. And that's the reason I'm still doing it.
Well, fantastic. So 34 years. I keep saying 33. It's right. It's already been another year. Well, you know, another thing that I want to get into tonight also is the fact that, you know, you hear, those of you listening to this webinar, listening to it live, you hear Tom and myself on the Follow the Money weekly radio program each and every Saturday morning, but you often don't have an opportunity to ask a question directly right there on the program. So tonight is your opportunity. We do want your questions. Bring them specifically. We want specific questions, and we won't give out your name. Don't worry about, you know, me saying so-and-so, full name from this particular city. But, you know, I'll veil your name. But if you have a specific question that you'd like to ask, or even for a friend, we do want to entertain those. Now, you're going to hear us talking quite a bit, but then we're also going to take occasional breaks and find out what you're saying. So if you want to type a question in at any time, go right ahead, and then we'll go back and look through the questions and try to get to all of them if we possibly can. So to do all that, we better get started. First of all, I want to introduce you tonight to our brand new logo for the 5 levels to financial freedom. We just released this brand new look with the release of our last FTM quarterly newsletter. We're very excited about the 5 levels of financial freedom because they are not putting the cart before the horse. You've heard me talk about these extensively on our radio show. And tonight, because we're talking about precious metals, we're in particular talking about 2 areas. That would be level 3 and that would be level 4. Level 3 is where you begin to take your 6 months diversified savings reserve, that 6 months liquidity that you're going to build up in level 1 and level 2 and level 3, and then you're going to diversify it. And precious metals is a great place to diversify perhaps a third of it, gold and silver. Now, we're not talking about your investments. We're talking about your 6 months liquidity. After we have our 6 months liquidity, then it's time to start investing, because you know that a good saver and someone who has a nice cushion makes a heck of a much better investor than someone who is flat broke and trying to hit a home run with every single investment. We want you to have a cushion. And so level 4 is where you actually begin to invest in precious metals. Many of you are ready to invest in precious metals. You have cash. Maybe it's in an IRA, or maybe it's in a old 401k. You're ready to begin to go into precious metals. Some of you may already have some exposure. Some of you may have too much exposure. Some of you may not have enough. So tonight we're going to be talking about adding that into your investment mix as a part of the 5 levels of financial freedom that we talk about all the time on our website. Now, there really are several trends that are driving gold higher. There really are. The very first trend, Tom, that we're seeing are fears over economic meltdown. Everywhere we turn, you know, and Tom, I know you've been preaching this same gospel for a long time. I've been out speaking it for 5, 6, 7 years, warning Americans and Christians that there is a massive, massive problem. There's fears over economic meltdown, and obviously it has a lot to do with the debt that we see, an out-of-control federal debt, $14.3 trillion. It's an astounding amount of debt. Tom, it's out of control.
Well, it's way out of control, Jerry. And, you know, the thing, I talk to people, and just literally, it's like this year, after 10 years, it's finally, people know they need to do something. They know this thing can't be fixed. It's mathematically impossible. You can't, if you try to raise taxes on everybody, then you put the economy back in recession, and tax revenues would fall off, and you'd have a bigger hole to dig. So, as we all know, that have been in this a long time and are economic students, you know, we know that the only way out of this thing is to inflate their way out eventually, and we'll get to that as we get into QE2 and what we're going to look at later in the year. But also, at the same time, we have this massive debt overseas that's also in sovereign debt, where countries are going under. But unlike us, they're not willing to print as much, and they're trying to take the hard knocks. But since we're not doing it, they're not doing it. And all of a sudden, we just look and see not only states in the United States, but countries around the world, especially Europe, are just piling this debt up. And we know there's no way to ever repay it. And I don't know how people think we're going to click our heels and solve this problem. That's what's amazing to me. And they sit and watch silver go up 83% last year. It's up 70% this year in 4 months. And it's still got a long ways to go. And even if it comes down $5, it'll just make demand stronger. So we just have to realize that people are getting the picture, and people like University of Texas, as we saw, spend $1 billion in gold and took delivery just to diversify because of the debt problem. And then we find out yesterday they're talking about doing another 5% or another $1 billion sometime this year. And then Northwestern Mutual Life Insurance Company comes out and buys, I think it was $420 million of gold. So we're seeing everything tipping that way. And this is when, you know, our clients can be in there and enjoying it, because the big guys are coming in and helping dry up the physical market for both gold and silver.
And even at the federal level, of course, we're having problems. You mentioned the global area as well. But we do have a crisis in the states as well. I mean, a budget crisis in the states. 44 of them are anticipating shortfalls, and of course that even goes up as we go out even further. It's just a mess no matter where we look at. Of course, the federal budget crisis, Tom, is an absolute train wreck. It's taken them 6 full months to simply come up with the budget, the fiscal year budget for this fiscal year, and they were quibbling, or whatever you want to say, over a measly, what, $33 to $66 billion. When the
Well, they came out and said they were going to cut spending $38 billion, which was 1% of a $3.8 trillion budget. And then the CBO, the Congressional Budget Office, comes out 4 days later and says, no, you really raised spending $300 million. And that's the day that gold and silver just hit the dollar. The last 3 days, it's just taken a big drop after that announcement on Monday of this week. And it's just absolutely amazing that every time they get up and say something, it's not the truth. It's just not the truth.
And, of course, we have the jobless numbers, again, coming out on a regular basis. We're continuing to see this quote-unquote jobless recovery, which we put into parentheses because it's a completely bogus thing. This recovery, we've been telling you for some time, has been completely bogus, and it continues to be. There's no plan to fix America's economy at the federal level. Even the politicians that are coming in now from the Tea Party, bless their hearts, they have a great desire to do something, but this ship is very, very big, and it's going to be very, very difficult to turn around. You mentioned, Tom, the euro debt, and of course that's been in the news ad nauseum lately, as many people are concerned about the euro crisis in the eurozone. And of course, here's a slide showing much of the debt and the debt loads and how they're obviously going over their anticipated targets for GDP debt ratios. And this brings the Treasury question. And this ties right into precious metals, because the question becomes, who is going to buy the U.S. Treasury debt? As the United States continues to consume, it needs to borrow. It's simply living on borrowed time. It's living on borrowed money. Up until this point, we have heavily relied upon Japan. Japan has been one of the most faithful buyers of U.S. Treasury debt for some time, for many, many years. And, of course, now they find themselves in a very big problem with their recent disaster. They're actually converting a lot of their own money simply back to yen to take care of a lot of things that they have to take care of. They're having a lot of problems right now. They're going to have to rebuild in many ways. There's some economists and analysts simply calling Japan an emerging country almost, the way that its economy has went recently. So it's certainly moved to a place where it's not a big buyer anymore of U.S. debt. At least that's what we're seeing as we look at it through our analysis. China has obviously been slowing down its debt buying. Its appetite for U.S. debt has went down. Simultaneously, its appetite for precious metals has gone up. Then we have Europe. And Europe, of course, as I showed you in the slide before, they're having a massive problem. They got a massive headache on their hands. They've got to salvage their own Eurozone. They're not interested in propping up the U.S. empire and continuing to fund it. They're trying to create their own type of bonds that they can issue that will be even a competitor, a great competitor to the United States market the way it is now. They have a very unsophisticated form. They want to have a much more integrated form. And then, of course, who else? Institutional investors. Are they going to buy Treasury debt? Well, we have PIMCO's Bill Gross, Tom, who is saying, look, we're dumping all of our bonds. We have a lot of the major hedge funds who are saying, we're steering away from government debt. We're moving towards gold and agricultural commodities and energy. So the big question, Tom, who is going to buy the U.S. Treasury debt?
Well, this is a question because when QE2 ends in June, can you imagine that the Fed could not even buy U.S. debt 16 months ago, and now they're buying 70% of the debt, which means they're creating money to buy expiring U.S. Treasury notes and bonds, and then they've got to have more money for new money in addition to the rollover money. So we get into that compounding effect, and we all know what happens when interest starts compounding. And they can't be the buyer of last resort, because it's just building up a huge potential for hyperinflation. But everything will come to a head this June if QE2 really stops as it's supposed to. Then we're going to have a sagging economy. Yes, we'll still be able to attract a little bit of money from Japanese and Chinese to buy our bonds, because we maybe see a little interest rate rise, but we're going to see a fall economy here, unemployment going back up, and the money that's been put in the stock market, primarily for quantitative easing, is going to cause the stock market, in my opinion, to make a very sizable drop. What I think will happen is they will not start QE3 my sources in Europe because there's so much pressure on the U.S. Not to, because nobody will buy their debt. That's what they're using for leverage. So I envision it July, August, September, and then sometime this fall, the establishment's going to realize Obama has no chance to get reelected if he goes into the fourth year of his term and the economy is in a recession. And this is when things, in my opinion, are going to be the start and the tipping toward the higher inflation. And whether it reaches hyperinflation, I'm not ready to make that prediction. But I am ready to say that QE3, it may not be called that, will have to come by the fall of this year, or people like Bill Gross at PIMCO and other top bond managers will dump. And then the last problem on that is when that dollar hits 72 on the world index, this morning it went below 74 for the first time since June of 2008 when the crisis started. There is not a next, when it breaks that support level of 72, some people like James Sinclair think it'll go all the way to 62. And for the listeners that didn't hear our first webinar, over the last 10 years, for every 1% the dollar goes down, gold goes up between 12 and 13%. So we're already down 5% this year with the dollar. Gold's not up 60%. Silver is, but gold's up a very respectable 7 or 8% this year. But that's when you're going to see money coming out of bonds, and because it is the biggest market in the world, just a small percentage of that money moving to gold and or silver is going to cause what could be a potential parabolic rise.
And I agree with you on that. You know, as we look at, in fact, there is a chart I'm putting up on the screen right now that shows that there has been a lot of new debt created, of course, over the last, several years. But look at the GDP numbers. This is what's so shocking, friends. If you think about it this way, the Fed is a surgeon, and the U.S. economy is the patient. And so the Fed comes in. Its role is to play the emergency room doctor. It has to pump in, some fresh money in order to create some sort of semblance of normalcy back in the economy. The amount of money that was pumped into this economy to salvage it was absolutely record-breaking. It was unprecedented. It was unreal. Look at what we see in the overall GDP. Look at what we see in the overall GDP over the last several years. What we see, and also what we see in unemployment. Can you imagine how much money has been pumped into this economy? And the fact that we are still asking the question, where are the jobs? This shows that the Fed has become completely impotent in many ways. Its monetary policy, its quantitative easing, is beginning to lose effect. It's not true, though, in some asset prices. The Fed is very effectively creating that wealth effect, and it is driving up stock prices. If you've opened up your 401k or your IRA statement lately, you're seeing your stocks moving up nicely. If you're buying into gold and silver and energy, you're seeing the effects of quantitative easing as the Fed continues to pump money in. We both believe, Tom and I have both talked off the air about this. I have been very, very strongly stating, based upon my sources and what I understand, the QE3 is coming. Now, whether it's going to be called that or something else, it's highly doubtful that it'll be called QE3. But when this QE2 ends at the end of June, we believe that the Fed is going to play a game of chicken with the investor, because right now there is a big backlash against the Fed, and the Fed does not have very much political capital or much wiggle room to pull off a QE3. There's not very many people willing to support that. It would be very politically unpopular for any presidential candidate to side with that right now, because we do see stock prices rising. We do see some semblance of a quote-unquote recovery. It's an illusion, but at least it looks decent. But if the Fed ends its program and the stock market begins to crumble and you're having continued unemployment and your 401k statement is going down, and all of this, guess what? The Fed is going to be called back into action. Even though it can't solve this problem, in some strange way, we feel better when they're printing more money. And when they get that green light, when they get that permission slip to move into a quote-unquote QE3, that's when gold, silver, and every hard asset that's not nailed, that's nailed down and that can't be printed is going to begin to skyrocket, in my opinion. And we could also see another major stock rally. But in between, this is the key part. I'm telling you, friends, I'm watching this very closely for my own investments. In between the end of QE2, which is going to be at the end of June, and the initiation of a quote-unquote QE3, there could be a very big dip. The media could come out, Tom, and they could say, gold and silver, look, they're falling because, you know, there's the money printing has stopped, and interest rates are going to go up, and interest rates are going to kill gold and silver, and all the gold and silver investors are going to look at the exit doors. Many of them will sell, and I want to be standing right there, Tom, to buy their gold and silver right off them, because I believe that after that event, the Fed is going to get its green light to do another round of quantitative easing. And when that announcement's made, those who are bullish on gold and silver are going to realize the game is up. It's over. Tom, what do you think?
Well, I think you're exactly right. And one thing that is so changed from, 30 years ago when we were going through this is back in 1979, 80, 81, Chinese citizens could not own gold or silver, and you had a few European countries that believed in it, but there was really no one out there. It was the fundamentals where everything in the U.S. is what was driving gold and silver up through our double-digit inflation. But this time, because everybody in the world's buying it, we even seen the Central Bank of China advising their citizens to buy gold and silver with their surpluses, and we're seeing the same thing in India, and especially in the Soviet Union. So you see these people buying metals. So I do think you're right that we will see that price come down, and we do know silver could get hurt worse than gold if quantitative easing 2 ends. There's a 60, 90-day period, like I said before, they have to rescue it. We saw it in 2008, where gold was the only investment for the year that went up, because gold is money, has always been money from Genesis 2, when God put gold in the Garden of Eden as a means of exchange. And it's been there, and it'll be there in Revelation 20, when we're walking the streets of the New Jerusalem. So this was something created by God as money for our use, but it's been completely abused by fiat currencies and coming in. So I think that the fundamentals will keep the price from going down as much as many people will think. I do think there'll be a dip, but I don't think it'll be a large percentage, because once the thing, say, pulls back 10 or 15%, then you're going to have people buying it knowing it's going to go a lot higher. So it's almost the same scenario that you painted. I think it's just slightly different.
Well, trend number 2 is the fact that the masses are beginning to wake up. As we look around, we've certainly gotten the attention of the masses with these gold prices. You look at the last year, it's moved from 1150 this time last year, all the way up to $1,500 now, broaching that $1,500 level. As we go back 5 years, we see that it was down even below $600 just 5 years ago. Well, friends, wouldn't you have enjoyed that? And some of you probably bought down there, and that was a great time to buy. And then, of course, if you go back all the way back to 2001, about this time of year, you'll see that it was down in the 250 range, which was a wonderful time to buy. And, of course, we've seen this massive bull market over the course of the last 10 to 11 years in the gold markets. And when you compare gold to the S&P 500, in fact, all the stock markets, you'll find that gold has been trouncing all of them. The S&P 500, if you'll take a look at this index here, I use the GLD, which is simply the ETF. This is the gold ETF, which tracks the price of gold. So it's very, very close. But you'll see that gold has trounced the S&P 500 over the last 5 years. They look very similar, these charts, to the Dow Jones, the gold versus the Dow Jones. And then, of course, there was a new chart that was put out today, Tom, the Dow and gold ratio. Why don't you explain to us what the Dow to gold ratio means and why where it's at now is important?
Well, it's important because it got way up to, trying to recall, I think it was, you have a graph on that, you said?
Yeah, the graph is right after the gold.
Oh, I see it. Yeah, but what you had back, it was like 44 to 1 back when this move started, and there were people predicting that it would get back to par, where 1 ounce of gold, let's say that gold got to 3,000 and the Dow came from 12,000 down to 3,000, it would be 1 to 1. But we watched a 10-year straight situation where the ratio is coming straight down because gold's going up and the Dow has gone down over this 10-year period. So when you take the Dow and you say it's, I'm not sure what it is today, 12.2, and you divide that by 1,500, you see it's down to 8 to 1 when it was 44 to 1 only 10 years ago. So it's now broken into single digits, and there are many of us out there that think sometime in the next 3 to 5 years that the gold and Dow will cross, where 1 ounce of gold would buy 1 share of each of the 30 industrial stocks that make up the Dow Jones. So that still is a clear signal that gold is gaining on the stock market for 11 out of 11 years.
Something else. We have the chart up now, the gold versus the NASDAQ since 2005, and it looks very similar to the gold versus the S&P and the gold versus the Dow. And what's interesting is if we go back to the 1970s, to that period of stagflation, where the Phillips curve, just kind of that idea that inflation and unemployment could not occur at the same time, that obviously broke down that whole consensus. And what we saw back in the 70s was that in nominal terms, the market moved into a sideways pattern. It was going up and going down and going up and going down, very similar to what we've seen as of late, although we have had some upward momentum. But back in the 70s, in nominal terms, it looked like a sideways market. But in real terms, and real terms mean that you factor in inflation, the real numbers showed that the market was losing water. It was actually going down. Investors were losing money. Even though it looked like it was going sideways, inflation was wreaking havoc. And this is what the masses are beginning to wake up to. Tom, you know, as I've went around the country talking at conferences and speaking, you know, this trend is truly happening. We're really beginning to see the people begin to wake up. 5 years ago, when I would walk into a church and speak about this, you know, eyes would glaze over. Who buys gold? Who buys silver? Now, you know, the uncles and the aunts and Pete, your coworkers are talking about silver and they're talking about gold. We're beginning to move, getting closer. We're not there yet, but we're beginning to move into that mania stage. We're not too far away, but I don't think we're there yet. Do you? But we're getting.
No. We're still just 1% of Americans own gold, slightly over 1%, and not even 1% of Americans own silver. And for the ones that were on our first webinar, we told them that, you know, it got up to where 4% of investors own gold and about 5 or 6% own silver back in 1980. So think about that. But the eye-opening chart that you just showed on the nominal and the real, it's the same thing with every investor out there today that's got money in a money market. First of all, you got to realize the money market, most of them, unless they're backed by U.S. Treasuries, are backed by commercial paper. Commercial paper is an IOU. There is no collateral. And you're out there, you're putting your money in your money market. It's being loaned out to people that need money, which means there's a risk. And these companies are just signing a note and putting nothing up for collateral in these commercial paper money markets, and they're paying 0.75%, 1%. In the first 4 months of this year, the dollar's down over 5%. So it's the exact same thing that you just showed on this graph. Normally, people say, well, I'm going nowhere. I'm making 0.5%. but in reality, they've just lost 5% if they had money in paper investments over the past 4 months. And this is what people are waking up to. Most of the calls I'm getting are people are finally understanding that 1% and 0.5% is a guaranteed loss. And it's really hard to comprehend when something goes up 83%, like silver did last year, and you tell a client it would have taken 166 years to get that kind of return in commercial paper.
Wow.
And you just think about it, and it's, you know, you got to step out there. But that's the reason I like the strategies that you and I have talked about, that you developed, because people have got to go out there and put their reserves in different areas and take chances. And then one last statement. Just this year, when I have excess money that I don't need, I put it into FXF, which is the ETF for the Swiss franc. That thing in 4 months is up 8%. So even if you think gold and silver is too risky, put your money in a foreign currency ETF, the Australian dollar, the Swiss franc, Canadian dollar, the three that I use. But all three of them are way up the last 4 months. I'm not making 1.5%. I've been making 2% a month by just taking my dollars and immediately put them in the Swiss franc. So that's the way investors have got to start thinking, and I think through education like this, they are, and I think people are waking up.
You know, Tom, it's funny that you mentioned that, because today, on today's article, we've been doing a teaching series on gold and silver and, of course, precious metals and foreign currencies as a way to diversify that DSL, that diversified 6 months liquid savings reserve. And we just mentioned some of those ETFs. So, friends, if you heard Tom mention the ETF and he said, hey, what did he say? I need to write that down. You can simply go to FTMDaily.com, and if you're listening to this live, it'll be one of the very first articles. If you're listening to this later, just go into FTMDaily.com and search for foreign currency, and you'll find several articles about that, and you'll see some of the things that we're actually doing here at our organization. Good point, Tom. A very good point on foreign currencies. We're going to talk about those in just a minute. Trend number 3, gold is beginning to return to its true historic role as money. Tom, you brought it up. Gold and silver have been used as money for millennia. The Bible tells us that God says the gold and the silver are mine. He says nothing about the paper money. He mentions nothing about the dollar. I don't think that he's impressed that we have his name on the paper, because he never ordained the paper. He ordained gold and silver to be money. And that's exactly what the Constitution even reads, Article 1, Section 8, that gold and silver are the only things that can be considered money, and only coins are allowed to be money, never mentioning paper, and never, of course, allows us the right or permits us to outsource that to a central bank who actually has foreign interests at heart. So trend number 3, gold is beginning to return to its true historic role as money. We are in a very strange time, friends, economically. We have been in this era where we've been doing paper money. It's very different. Let me explain real quickly the 4 stages of money, how they work in any normal society or civilization. If you go back in history, you'll find that civilizations begin and they need to trade. And so they'll often use sand, or they'll use shells, or they'll use even sometimes livestock. Of course, gold and silver, when they were used, that was obviously very good, because you want your money to be durable, you want it to be divisible, you want it to be portable. And so anyway, they used commodity money. Eventually, as people began to accumulate, they decided to move to receipt money. This is the very first form of paper money in any society. Basically, you take your shells, you take your sand, you take your salt, you take your feathers, you take your gold and silver, whatever, and you put it somewhere in exchange for a receipt in exchange for that. And then you can go out and you can use that as money, because the person can go to the storehouse and then pick it up. That's the second stage of money. The next stage is that the government comes in and says, we need to regulate that. They're so good at that. And so they want to come in and they want to regulate the receipt money. And so they come in and say, listen, don't worry about it. We'll take care of that. Don't worry. Just trust us. So they come in and they create something known as fiat money. Government, or money by fiat. It's basically by government decree. Eventually, the government will then take away the commodity backing from it, because you know what? It's very difficult to print money if you constantly have to have more commodity to back it up. And so they take away the gold and silver backing. For example, here in the United States, that occurred in 1971, actually began back in the 30s, but back in 1971, we went completely off of the international gold standard. Dollars were no longer convertible into gold. Foreign holders of the dollars could not convert right to gold, and so it instantly became a fiat currency. It was simply backed up by the full faith and credit of a very bloated, debt-filled government. Stage 4 has always been, and probably, Tom, will always be, hyperinflation, because the government itself cannot help itself. It wants to do good. It has all of these ideals that it wants to do. It has all these entitlements that it wants to give. It has all these wars that it wants to fight. And so it decides that it's going to print more and more and more until it finally hyperinflates the currency. Take a look at this dollar that I'm showing you on the screen. This is a 1928 silver dollar. This is what our dollar used to look like. You can find these in pawn shops now. You don't find them anywhere at a bank. And you'll notice that it says at the very top, silver certificate. This certifies that there has been deposited in the Treasury of the United States of America $1 silver dollar payable to the bearer upon demand. Very different, this 1928 dollar, to our current dollar, our current fiat dollar, which at the top no longer says silver certificate. You're not entitled to silver for this. If you walk in to a bank with this dollar bill and you ask for a piece of silver, of course they'll laugh you out of the bank and act like that never even existed. The truth is it used to before our government hijacked our money. But at the very top it says Federal Reserve Note. And if you take a look very closely, you'll see that this note is legal tender for all debts, both public and private. So they hijacked the money system. They took away the commodity backing, and this is the same 4 stages that all money goes through all over the place. Let's take a look at a brief look back. 1933, gold coins are no longer used as currency. The Gold Act is passed, I believe it was by FDR, and it outlaws gold coins. In 1971, as I mentioned before, Nixon abandons the international gold standard after many nations are using the Bretton Woods Agreement to come in and basically hedge their bets, bringing in their dollars anytime they feel like things are getting out of hand. In the early 1970s, of course, the United States was mired in debt. It was mired in the Great Society thinking. It was mired in the Vietnam War. And the Europe said, whoa, hold on, we want some gold. You're getting out of hand. And then, therefore, Nixon said, no, you don't. We're going to close the window entirely. So no gold in exchange, and you're just out of luck. 1974, U.S. citizens are allowed to hold gold for the first time in 40 years. So then they were actually able to begin buying it and actually holding it. In 1980, of course, Tom, as you were mentioning when you got into the business, you saw it rise to $850 an ounce. And, of course, that was the real big price hike back in those days. And now we talk about legal tender. And, Tom, I want you to comment on this. 2011, Utah becomes the first state to make gold and silver legal tender. The state of Utah now officially recognizes gold and silver coins issued by the federal government as legal tender in the state. Talk about some of the dynamics of that new law.
Well, I'll talk about a couple of dynamics. First of all, there's 14 states. Here in Georgia, we're the second state that will probably pass it. We're very optimistic it'll be passed in Idaho and Virginia. There's 14 of them total, but you know, it says, and I'm getting calls every day saying, well, don't I need to buy silver eagles because Utah is going to make the only silver and gold allowed is going to be U.S. Silver eagles and silver gold. Well, it's still not going to be. They only expect less than 2% of the citizens to actually use it as legal tender. Most people will still be using paper money, but the advantage to our clients that do own silver, to have some, they at least have the option to use it. But you don't want to take your investment money and go use it to spend. I still think you let your silver grow, and then when you need to buy something, of course, that's when you go in and trade, use that for something, and that 6-month supply of money you have. But don't watch this thing to explode overnight. It's going to be a very slow growth process, and any silver you have you'll be riding up with silver. So even if you had to liquidate silver to buy something, even if it wasn't taken in exchange, it's still going to be very positive for your silver. So a lot of you out there that have called, this is the very infancy of this whole movement, and it will be a movement that will take years before it's a major impact. But the good news is it's people realizing the responsibility they have to their citizens to try to go back to where gold was in 1971 and where silver was in 1928, and you can actually redeem it there and not have to worry about the prices going up. I made a speech to a civic club and pulled out a quarter about 3 weeks ago, and I said back in 1964, this quarter bought a gallon of gas, and I said, do you think it'd buy any gas today? Well, there were about 4 or 5 of them that knew what I was saying. They raised their hand. Well, that quarter today is worth 31 times just the silver in it. So now it buys 2.5 gallons of gas instead of 1 gallon of gas it bought in 1964. But it's the same thing we see over and over. They can't create the junk silver out of thin air to work, and it just keeps getting worse, and we'll keep seeing these products, go up. But don't, be happy that this is happening, but don't think it's going to make any, everybody in Utah is not going to run out and buy $1 zillion of silver eagles to spend. There'll be a few that will, and it'll grow as the years go by, but it's still not any difference how much silver is going to go up. It may help it a little bit, but where you're going to win is when, like I said, you've got your money in metal, and as that inflation inflates and commodities go up and food prices and everything else, gasoline, you're going to be able to take your silver and go in there and buy it cheaper because you've had your paper money in silver.
Very good point, Tom. Very good point. Well, let's move into trend number 3, the failure of the paper money experiment. We had talked about this, alluded to it a little bit earlier. Here's that chart that you were talking about of the U.S. dollar index, the U.S. dollar versus a basket of currencies. We see that over the last 10 years it's down dramatically. This has been the result of very poor monetary policy. And, of course, this is what a chart of a currency looks like near the end of an empire as we go back through all of history. Now, I want you to notice something interesting as we go through these charts very quickly. Here's the U.S. dollar 10-year chart. You see that it's going down. Everyone would say that's a downward trend. Now, notice this. Notice the Australian dollar. Look at the chart. You'll see from 2001 all the way up till now, this 10-year chart, you'll see that the Australian dollar has jumped against the U.S. dollar 102%. That is astounding. Australia actually had the foresight back in the late fall 2009 to begin raising interest rates. They actually have relatively low unemployment. They've actually done a very good job. They're very commodity driven. They're sending a lot of exports to China. Not really relevant here, but the point is that Australian dollar against the U.S. dollar, very, very strong, strengthening against the U.S. dollar, up 100% over 10 years. Here's the New Zealand dollar up against the United States dollar over the last 10 years, 82%. Here is the Swiss franc that Tom was alluding to earlier. Over the last 3 years, up 17% just over the last 3 years alone. Here we see the Canadian dollar over the last 3 years. It's up about 6% against the U.S. dollar. Here's the Brazilian real, 2-year chart showing it up about 23% against the U.S. dollar. So the question becomes, what do? Do we go out and we buy foreign currencies? Well, yes and no. Yes, because you do need to hedge your bets against the dollar, but don't think that because they're going up that they're not going down also. The truth of the matter is that everything is a sinking boat, and we often use this illustration, a hole in the boat. All currencies are like a sinking boat on the water, and some of them are sinking slower than others. You want to get into the boat that has the smallest hole. If you saw a boat that were both equally sized, 2 boats, both equal sized, one has a quarter-size hole in it, and one of them just has a little pinhole in the bottom, which one do you want to sit in? You want to sit in the one that has the smallest hole. And so that's what foreign currencies are all about. The dollar has a big hole in the bottom of its boat. The Swiss franc, the Australian dollar, the Canadian dollar, the New Zealand dollar, and the Brazilian real, and some of these other currencies, they have holes too. They're just smaller holes. But in the end, they're all losing value over time. Look at this failure of the fiat currencies chart. Here you see the United States dollar. The red mark here that you see as it goes up, let me highlight this so you can see it. This red line right here represents the currency being put into circulation. You notice that as the currency is put into circulation, notice what happens to the value or the purchasing power of the currency. It goes down in tandem. So there we have that on the chart. Let's go ahead and take a look at a few others. Here's the Canadian dollar. You'll see the same thing. As the currency in circulation goes up, the value of the currency goes down. Here's the Swiss franc. Notably not as bad, but you'll see that it is, as the money is put in circulation, the value goes down in tandem. Here we have the pound, the Great Britain pound, of course, terribly going down as more is put into circulation. Here's the Japanese yen, faring a little bit better as it's been printed and the value of it has went down. So we have seen a tremendous failure of fiat currencies. Here, of course, we see the Australian dollar as it's put into circulation, and we see a decline in it. So the point being is that foreign currencies are a good place to hedge your bets against the United States dollar, but remember, those are still sinking too. So we get many questions, Tom, and you get lots of questions. I do too. Let me address this one real quickly. Some people say, well, why shouldn't I just put all 100% of my money into gold and silver if the dollar's going down and if all foreign currencies are going to go down in the long run? The point is that you don't want to put all your money into one basket. Some people say, well, that's because you think that you have to diversify, but you don't have to diversify if you're smart. No, that's not why you diversify. You don't diversify because you're not smart enough. You diversify because the government can change the rules. And the government can change the rules any time that it decides to. Therefore, it's vital that you are nimble, that you're spread out across multiple asset classes. That way, if they change the rules in one investment area or one asset class, you're not destroyed. Many people are going to be laid waste over the next 2 decades as this out-of-control government is going to start doing very bizarre things in order to raise capital. If you are relying upon your home and your 401k as your retirement plan, those are both government controlled. You need to be very, very careful. Not saying that you shouldn't have a home, not saying that you shouldn't have a 401k, but those are two sitting ducks. Tax benefits that you receive on your house, those could be taken. Property taxes, so the states are going to turn to those. 401ks, distribution taxes can be raised. IRAs, those things can be raised as well. Anything tax deferred. Look, you need to be very, very careful. My point is don't dump all your money into one thing and think you found the silver bullet, because the government will come after whatever they think is the silver bullet. They want money. They want cash. So you have to outsmart them. You have to be widely diversified. That's what's so important. So foreign currency does deserve a role in your plan if you have many assets, because it provides that hedge, as does gold and silver. But don't become over-leveraged in one thing. Don't have 100% or 80% of your assets in one single asset class. Okay, so let's move into the fundamentals, Tom. And before we do, I tell you what, let's get to the questions, because we have some, and I want to give some time for these. And then we'll move into the demand and then into the supply, and then we'll talk about a few more things before we close. We got a lot of questions. Let's kind of move through these. Okay, let's see. From the top here. Wow. Okay, I have a question here from Todd about, is it practical to hold silver in an IRA? Tom, let's hold that, because we're going to get to that question. So Todd, hold tight. We will get to the question about IRAs and holding precious metals in those. Diane asked the question if we expected a correction in gold and or silver. Tom, I think we both addressed that. We do see a correction coming.
Oh, absolutely. You're going to always have a correction. That's very healthy. Nothing goes up every day. And so we actually hope there will be a correction. And I think that battle will come when the dollar drops a little further. They'll have to, like you said, intervene and do something to try to push the dollar up temporarily, and that will push gold and silver down. But it may be silver may be over $50 before that happens.
I got a question here from someone who says, Jim Rogers this week talked about silver increasing in a parabolic curve and how anything in a parabolic curve does not end well. Your thoughts about this comment and when it would be appropriate to exit precious metals?
Well, I sent that out to everybody on my email blast today, and a lot of the people listening saw that, and I hope that you just didn't read the article, but you went down and hit Jim Rogers' face, that era, and listened to what he had to say for 4 minutes. What he says is, if a parabolic rise, if silver got to $100 this year, he would consider that a parabolic rise. But he went on to say, when you listen to the tape, that he doesn't expect that. He just continues to see a straight progression up for about 7 more years. And that's what I've been saying too, almost identical, that I think he'll do that. But certainly if we do get a parabolic rise where it just goes straight up for 2 straight years, 83% last year, over 80-some% this year, 100%, and then gets into like a 1979 and 80 where it goes up 7 times in 2 years, 2.5 years, then yes, you would move out, and then you'd find you a good, the best currency to move to. You sure would want it in dollars because that is going to be what caused the major part of the problem. But I don't think it's a parabolic rise at all, because until we get 3 or 4% of the public moving into gold and silver, I don't see any way it's going to go parabolic where it's going up, you know, for $3 or $4 a day and doubling every 2 or 3 months like we saw back for that 2 years back in 1979 and 80.
Yeah, I really like the way gold is moving right now. It's just making nice new highs, and it's just moving really steady and strong. Silver, you do sense the momentum. You do feel a little bit of an urgency. You sense that people are kind of rushing into it. And it doesn't necessarily mean, and of course I'm speaking to the question, the person who asked the question here, it doesn't necessarily mean that we're going to see silver just demolished because of it. But however, Tom is so correct when he says, you know, nothing goes up in a straight line. You're going to see zigzags along the way. Overall, when you lay a ruler over that chart, you'll say, wow, that was an uptrend. But it won't be the straight line up. It'll certainly have its ups and downs, and we expect silver to be very volatile for the rest of the year as many people rush in, and many of these people rushing in are first-time investors. Keep that in mind. So they may jump out very quickly. Many people are moving some of their 401k and IRA assets over into silver and trying to gain exposure, but they're also wanting to jump out if it begins to tank, if they even sense it at all. Plus, you have a lot of traders and speculators trying to get in and then get out. So we're going to see a lot of volatility here. It doesn't mean that we're going to see a downward momentum from this point on because it's gone too high. David asked the question, if the S&P 500, or I'm sorry, if the S&P rating agency pushes back the U.S. AAA rating, what effect will that have on precious metals, Tom?
Well, this is the biggest thing. This is the biggest risk. I mean, that's what caused gold to start this week. And one of the reasons the Congressional Budget Office announcement on Monday morning that the $38 billion cut of spending was really a $300 million increase. And then Moody's came out and said if the dollar breaks below 72, and here it is already below 74 today, we've only got 3% more to go. It's already down 5.5% this year. If it keeps the same rate, it could by summer be below 72, and then they've got by definition to drop the U.S. debt to AA, and really that's the end of the reserve currency status for the U.S. I mean, it won't just happen overnight, but that's when everybody leaves us as a serious place to have money, just like what happened to Britain back in the late 1700s. And we're looking at not a third world status, but we're looking at a secondary status as power moves more and more back to the eastern part of the world. But that's the scariest thing out there, the question he's asking, because we saw a tip of it. If you just remember December of 2010, gold and silver usually kind of quiet, go up a little bit in December, and all of a sudden we saw the bond market tumble 12% over these kind of worries that Moody's came out and said they were going to have to downgrade U.S. Treasury. And we saw gold go up 7% in the month of December, and silver 12%, the exact amount that the government bond market went down. And that's what people have to realize. And here's the biggest factor of all of it. Just what happened in December, where did people move? When people got scared in 2008, they moved to U.S. Treasuries because they didn't know where to go, and the dollar went from 72 all the way up to 86 because everybody was selling stocks, didn't know where to go, so they just got to safety as quick as they could. But now, when this money starts coming out of bonds, where are they going to move? Gold and silver only need to get a very, very small percentage to see some very big moves. And that's what we talked about earlier, what you see with the University of Texas and Northwest Mutual Life Insurance Company and many others, is they realize they've got to get over into that, and that's really when they start liquidating bonds. Where do you go? And that's where gold and silver is going to pick up a lot of their new business.
Okay, Tom, let's move through a few more of these questions, and we'll move back into the program. And if we don't get to your question this time, maybe we'll make it on the second round. Malcolm asks, understanding no one can predict markets, but assuming there is a pullback in June because of the Fed announcement, is it better to wait to buy into precious metals or to buy now for concern the pullback doesn't go below today's prices? Essentially, what percentage drop could the pullback be?
Well, there was 3 drops. Let's talk about silver real quick. In 2010, silver went down over 10% 3 times and still went up 83% for the year. What this question is, and today it's a great question anytime, but today it's a real important question because of the price level that we are. But on the other side of it, I used to spend 98% of my time selling people gold and silver as part of their portfolio, and 2% getting supplies because I knew all the major suppliers, had a great reputation with them. Now all of a sudden I'm spending 20-25% of my time on supplies, and it's incredible. And I will predict that there'll be a time this year, where somebody on the phone will call in and say, Tom, I want about 100 silver rounds or 100 silver eagles, and I won't be able to take the order because we're already being told that unless they have the silver in the pipeline to make the product, whether it's the U.S. government, Canadian government, or the large independent refineries that are making silver rounds and bars, they're not going to take my order for you unless they have the silver already in the pipeline when something's going up this fast. So I look at it that you need to go in and get in with some of it now because over the last 10 years, 61 or 2% of the gain of both gold and silver comes the last 4 months of the year. And I could spend an hour telling you why that is, but just take my word for it now that you can go look at charts. So I would say put part in now, wait to see if there's going to be a pullback in June and July during the QE2 ending. I think would be the wisest way to do it.
Yeah, Tom, I can't agree more. You know, Malcolm, what we've been saying even in our newsletter is if you're going to buy precious metals at all, if you haven't bought it, but you're going to buy it, for heaven's sake, do it by August. Because come September, October, November, December, we move into those last 4 months. You know, that's when a lot of the gains are made. So if you're kind of on the fence and you're not really sure if you're going to buy, you know, make up your mind, pray about it, decide what you're going to do. But if you are going to buy, you know, I'm thinking by August is probably the latest because we will see a nice run-up in the last quarter if everything holds true historically. Okay, let's get to 2 more questions. We'll make them brief. Mark asks, let me see. Mark, I'll get to your question in a minute. Amy asks, how do you invest in foreign currency? Is it a stock? Amy, we just wrote a piece on FTMDaily.com today explaining 3 ways to buy foreign currency. There's one way you can buy foreign currency through your local bank. Bank of America, for example, you can buy up to $5,000 of foreign currency through the foreign exchange department. You can trade your dollars for foreign currency. That's one of the more expensive ways to buy foreign currency. That's often if you're going to go on a trip somewhere and you want to actually have the physical currency. Some people just want to have the physical currency, but you know, it's all paper. It's not like precious metal, so it doesn't really matter where it's at. The second way to buy foreign currencies would be to through everbank.com. If you would like to buy perhaps a certificate of deposit through an FDIC insured bank that actually gave you exposure to foreign currencies, everbank.com is a very interesting bank. I'm not affiliated with them, have no interest in them, but I've seen some of their products and I'm very interested. I have never actually used one of their products, but I hear from many of our readers that they have used them and they do enjoy them. So that's another way to get exposure to foreign currencies. The third way, and probably the most easiest way that anybody with $100 or less could do, is open up a online discount brokerage account, maybe through Scottrade or E-Trade or one of these online brokerage firms, and buy a currency ETF. And we have a list of almost all of them in today's article. Tom had mentioned the Swiss franc, the one that he likes to use. That ticker symbol was FXF. That's Frank, X-ray, Frank. And that's the one for the Swiss franc. But you can also buy the FXE, which is the euro. You can buy the FXA, which is the Australian dollar. You can buy the FXJ, which is, I believe, the yen, or maybe that's the FXY. But either way, there's all these different currency ETFs that you can buy. Less than $10 to buy, less than $10 to sell. So that's one way to gain exposure to those. Mark asked the question, why bother with foreign currencies at all and instead just invest in gold and silver? I think, Mark, we've already answered that. You might have, I think I directly answered that question a little earlier. Okay, well, let's keep moving, Tom, and we'll get to some more of these questions. And if you have a question, please type it in. We will certainly get to all of them, even if we have to do it off the air after we stop this recording. Let's move into the fundamentals, demand and supply. We're going to begin with demand. As you mentioned, Tom, the University of Texas purchased $1 billion of pure gold. That was 41,000 pounds of gold, and they had it delivered to their to a vault, a secure vault in New York City. It was for their endowment fund, and it's interesting, Tom. They didn't buy numismatic coins with this. They bought straight-up bullion. They just bought the bullion. How come they didn't follow Glenn Beck's advice and buy the numismatics?
Somebody wasn't getting paid enough, I guess. That's a good question. No, the numismatic coins really are for collectors. We've talked about many times, but it's not just the University of Texas. We're starting to see other insurance companies, endowments, and everybody looking at it. It's going to do nothing except put more demand in the market.
Okay, I'm showing a chart right now with the gold demand in tons. We see back in 2000 that jewelry was the primary demand for gold, and now we've seen things really even out in 2010. As of last year, the investment demand is truly picking up. Let's name some of the sources of those, Tom. We have, obviously, central banks. They have become net buyers in some cases.
Yep.
We have
you've got individuals. You've got people all around the world, like we talked about the Chinese, the Indians. When the crop comes in September, they put vast amounts of money into gold and buy it. And you see now that, like you said, the central banks are buying it and not selling 400 tons a year like they were. They're not only not selling, but they're actually buying. But it's just coming from all directions, and certainly the jewelry has slowed down to about half of what it was 10 years ago. But it's because the price has gotten expensive, and so it's just naturally come down for 14, 18 karat gold jewelry. But it's not because people aren't interested. It's just a lot more expensive, 6 times more expensive than it was 10 years ago.
I'm showing a chart now, China's household gold savings, and of course China has been allowed to buy gold. In fact, the government itself is encouraging the people of China, Chinese citizens, to buy gold. We do see that as their household income is rising, we are certainly seeing their private gold buying rise right along with it. So obviously the Chinese are creating much of that demand. We also see that coin demand, investment demand is up, but this chart shows that it's still nowhere near where it was back in 1979, for those who think that we're nearing the peak of silver. Here's a very interesting chart that Tom was alluding to earlier when it talks about gold as a percent of global financial assets. This is a vital piece of information. This one slide right here tells a lot of things. Back in 1980, according to this chart, and this is according to the CPM group, gold made up 2.77% of all global financial assets. Now that's a lot of money. If you take all the financial assets in the world and you take a look at them, up almost 3% of it was in gold. But in 2000, less than 1%, in fact, it was 0.2% was in gold. And now even in 2009, we see that that number is still at 0.57%. Tom, you talk about this often, and we've showed this slide at various conferences that I've spoken at. This is really what you've been driving at for some time. When this number begins to move, as the masses wake up and they move into gold, that's when that parabolic rise begins to occur, isn't it?
Well, we've hit 1%. This thing through 2009, and Casey Research, I think it was last month, said that so it's almost doubled in 2 years, the percentage, primarily because the price of gold has gone up and other assets, especially bonds, have done nothing. So you've seen it go from 20.20%, so it's really gone up 5 times the demand picture in the last 10 years. And now we think it'll start jumping and back up toward that all-time high of 2.77% we saw in 1980. This time we expect it to go to 4% before this thing is over. To take the value of all the world assets, we expect in the next 5 to 7 years it'll go over 4% this time.
What do you think that will do to the price of gold? If 4%,
if it goes over 4%, we're hearing figures that range from as low as 3,200 up to 6,000, and it'll have a lot to do with how much money is created around the world, quantitative easing, all these other fundamental factors that, like you said earlier, the government can change, and we don't really know what those factors will be. So you do get a wide range where I've seen projections from as low as 3,200 could be 4% to as much as 6,000 or 8,000 could be 4%. But a lot of the experts are pretty settled in to think that gold will be at least 4% of the value of all investments within the next 5 years.
Okay, I want to move into the supply picture because I want you to share with the audience what some of the things you've been hearing from your suppliers. I'm showing a slide right now that shows that mine production is down, but scrap supply has been up since 1999. This is about a year-old chart, maybe 2 years old. It's showing that mining production has been stagnant or declining. And we also have this next slide that shows that gold mine supply has been heading down. That's, of course, at the mining part of the supply chain. What's going on in the supply, the global supply of gold and silver? What are you hearing from your suppliers? What should our audience know?
Well, the first thing they need to know is, you know, in America we like coins, and I don't have any problem with that. I love gold coins too. But in the rest of the world, about 65% of all the gold is in bars, and that's what the University of Texas took delivery of, was pure bullion bars, and so did Northwest Mutual, was pure bullion bars, my understanding. And you're seeing that these big refineries that make these, where things are slowing down are the countries where they're not making the coinage fast enough. Of course, in the U.S., they don't, all they do is stamp the coin. They buy slugs that are already an ounce of gold, and they put them in the press at West Point and turn them into an eagle or a buffalo or whatever product it is. The gold suppliers on the bullion coins don't see any, they see the price going up, but they don't see any major problem in getting it for the next year to 2 years. It's the silver where the problem is, and you may want to wait to talk about that. I can't remember if you got silver slides next, but we need to realize that silver is the one that on the supply side is where we're going to have the major problems trying to buy it and available. But our suppliers are also talking about premiums, and premiums being defined as what, when a spot price is unrefined gold or silver, and then the U.S. government makes a silver eagle or a gold eagle, that's the premium. And then when a dealer buys it from them and sells it, it's the spot plus the premium plus the commission, and all of it is in there. Well, what people don't realize is premiums have been going down because the price of gold has been going up, and a lot of the premiums are figured like on a flat amount. They may charge $50. The government may charge $50 over for a 1 ounce gold coin, and that may have been 5% last year, and now it's 3.5%. So investors out there today can buy gold and silver at lower premiums and commissions than they could have when the price was lower. But this is what I'm hearing is going to change dramatically, is things like COMEX silver bars in particular that have to be delivered in future contracts. There's only 4 hallmarks in the U.S. that are COMEX deliverable. Those have already gone up 30 cents this year. Now, that's not so much because silver's gone up so much, but what you could expect is extremely much higher premiums, because these people that are making the products are not going to sit there and watch silver go to 100, and they're going to sell it at the same premium because it'll just keep coming down. They're going to raise the cost of those bars to a minimum premium as to where they are now, and that catch up, because it hasn't caught up, and we've watched the premium for silver steadily go down over the last 18 months. We think is going to explode later this year and next year in silver for sure, and gold to some extent.
Yeah, I can't agree more about that, your forecast, especially with silver. We're going to get to silver in just a minute. Quick, brief sponsorship here. CFAN, Christian Financial Advisor Network, on the web at www.cfanetwork.org. If you're looking for a Christian financial advisor in your area, we are broadening our network across the country. We are in about 43 to 44 states now. We're not in every single state, but we have a Christian financial advisor in your neck of the woods in most cases. And you simply just go on to cfanetwork.org and fill out the brief online form. It's a completely 100% free referral service, and we'll put you in touch with someone in your area within 3 business days. www.cfanetwork.org. Okay, let's talk about silver, Tom. We just mentioned, I know we have several questions on this. I want to give our take on the silver markets. You've already done quite a bit. Here is a chart of 10-year silver, and you can see how it's flirted with really breaking out. Back in 2005, it had a real nice run in the fourth quarter. Then, of course, we saw a real nice run in the fourth quarter in 2007, something similar in 2008 after it kind of dipped in the middle. And then we have just seen nothing but up for the last, probably for about the last year. And it's pretty astonishing. Here it is on a 5-year chart. You can see silver, and of course on that 1-year chart you really see how you could have bought silver at less than $20 per ounce back in late August. Kind of stunning to think that it's gone from under $20 in late August all the way up now to $45. And so it has been rather quick how strong it has truly been. Tom, how much of that has been industrial demand? How much of that has been investment demand? And then one more thing, how much of that investment demand has been speculative versus just genuine?
Well, I think that first of all, you've got the industrial demand, and I've said it many times, but if nobody in the world bought an ounce of silver, and the Chinese alone, a country of 1,400,000,000 people, which is nearly 5 times the size of the U.S., just for the next 10 years, for just normal wear on computers, cell phones, high definition television, digital cameras, other photography applications, it's estimated that silver would go up 6 to 8% a year just by itself if nobody else touched it for investment demand. But of course, when something gets hot like this and more people can afford it, they come in, and I do think a lot of this has been industrial users hoarding it. I could tell you several stories about large industrial users that know it's going to be more expensive in the future that have gone on and bought it now and just actually going to put it away for 3, 5, 7 years until they need it, but they look at it as a great investment. But the investment side is covered two spectrums. Part of what you said earlier, we have the guy that puts X amount into silver and buys it, part of his portfolio, buys it, I don't know if you call it speculation or investment. And then we've got the really growing group are those people that are buying 1 month supply of silver in case of emergency. If the banks close like they did in Argentina and Brazil in the last decade, they have to have something to barter with, something to use when the currency collapses. And that's where many people listening can come in and buy 20 coins, 40 coins, 100 coins. And my friends that I talk to in the business, we all see the same thing. We see people like that haven't owned it before, but their first purchase is for an emergency fund, and that's the largest growing group in this whole thing. And while they don't buy a lot at one time, there's a lot more of them coming in the market, and that's what's driving it right now.
Yeah, I've had a lot of people who've contacted us who said, you know, Jerry, what do you think about me just buying silver just every month, you know, just accumulating ounces? And I really do think that's a really wise idea. And we mentioned this before, I think, on one of our precious metals market updates, that money, as we talked about earlier, used to be considered weights. You know, the Bible talks about just weights and balances, of course, referring to payment, referring to monetary methods. And for a long time, you weighed out your money. It was a weight. It wasn't a dollar. It wasn't a cent. Instead, it was a pound. That's why the British pound is called pound. That's why you know, gold is still sold by the ounce. So it's based upon weight. And of course, dollars and cents are not based upon weight at all today. So it's a very different system. But historically, that's how things have been viewed. And I think in the future, if we're lucky enough to see things change in our lifetimes, then we're going to see a move back towards more sane monetary policy, more honest money, and that will be more weight-based. And so I think, as you mentioned before, was it Malden or was it Embry who had made the comment, or maybe it was Sprott?
John Embry of Sprott Management, yeah.
Yeah, we were kind of on the same wavelength. I think that we both kind of got the same revelation at the same time, because I started saying, you know what, let's just start thinking in terms of ounces. Let's just accumulate out how many ounces of silver do you want to have, not how many dollars worth, but how many ounces would you like to have? And so maybe you want to accumulate. Maybe you can only buy 3 or 4 ounces a paycheck, or maybe you can only buy 1 ounce a paycheck. You know, you simply just want to begin doing that. I think it's a really wise idea. So that was one of the questions.
Well, we can only sell 20 minimum. Just remember, we can't get free shipping and get it sent out of the warehouse for less than 20 ounces.
Well, you know, Tom, if they're going to be buying one or two ounces, it might be best just to run down to the pawn shop or something.
Yeah, let's go to a pawn shop, absolutely.
But if they're going to buy more than that, they'll save a lot of money, you know, doing something different. Now I have a slide up that shows silver demand up, but still low, giving you some hope. This is a chart that was just put out showing all the silver ETFs combined. They're hot, friends. If you look at these silver ETFs, you're seeing many of them going up 2, 3, 4% in a day. Sometimes they'll open up and they'll go down, and then they'll go up 2 or 3% by the end of the day, 3 or 4%. And this happens over and over throughout the week. And
4 straight days.
Yeah, and they're really hot. But look at this chart that I'm showing you. The silver ETF investment is puny in comparison. All the silver ETFs combined are not equivalent to what's happening in McDonald's or Pepsi or Procter & Gamble or Walmart. You know, the volume and the amount of money that's in these, you can see how it's very different. So more people have bought McDonald's stock, you know, in the course of this time period than they have silver ETF. So it's showing you that the popularity is still low. It may feel like that everybody's buying it and you're missing the boat, but the truth is it's still very early in this game when we look at all the facts. What's driving silver? We have a list here. the gold-silver ratio, the explosive investment demand, which Tom had alluded to, the increasing industrial demand, which we had talked about earlier, the declining mining production. Tom, you have stated something very startling, and you've said it several times about how we could see the end of silver within a certain time period. Well, tell us about that.
Well, I mean, it's going to be the first element depleted from the Earth's crust that we grew up on our element chart. We're hearing anywhere from 6 to 10 years, there'll be no silver on the planet Earth. There's geological studies, several of them out. The latest one came out in October that predicted less than 7 years at current demand. And, of course, demand's going up, so it could be quicker. And then they're going, I don't know what they'll do with all the applications that you've got industrially to use. So it is shocking to think that we could live and see silver wiped off the planet Earth.
Well, you know,
it's just amazing.
If we see prices get high enough, I'm sure we'll see recycling begin to kick in like we have already in gold. But that's very interesting with silver. I mean, now what are the silver efforts with recycling now? Are they still pretty minimal compared to other metals?
Well, yeah, they're minimal, but it does make it. You showed a slide a minute ago, the scrap metal that comes back in, so they can recycle some of it. But that's still won't keep up with the kind of demand that's driving silver that we're talking about. Just the people play the ratio now. They've seen it go was 68 times more valuable than silver in January of 2010. Now it's down to like 33 to 1. It's getting right back more in the historical range, but still probably has a little more to go, and literally could go all the way back down to the 16 to 1 ratio, hang around the 32 for a while and then take off and go further. But certainly with the supply dwindling worldwide and demand picking up, you can easily see why the price is going up at the rate that it is.
Quick advertisement for those of you who are listening. If this kind of stuff is just what you enjoy, I mean, if this is the kind of stuff that you like to listen to, this is the kind of stuff that you like to read and study about, or maybe you're new and you're just learning about all this, but it sounds very interesting, I encourage you to go to our website and obviously be reading our articles we put out each and every day. I'm putting out a teaching article each and every day. It's absolutely free. I do a free radio show each and every weekend. It goes out all across the world, but especially in this nation. We have thousands and thousands of listeners, and many of you I know listen to the program. Tom is on there each and every week. He does a precious metals market update. We also do these monthly webinars absolutely free. All of these things that I mentioned are free. The only thing that we really charge for is our newsletter. Our newsletter contains our FTM investment portfolio. It's what I am investing in, what our team is actually currently in, and we allow you to look over our shoulder and see how we're performing. So far, we're beating the S&P 500, we're beating the Dow, and we did it last year, and we're doing it again this year. We invest in about 19 different securities, 10 or 11 or maybe 12 individual stocks, and 7 ETFs. The newsletter also comes with a subscription, so you get access to the investment portfolio. You get real-time updates whenever we make a transaction to buy or sell. Alert, you get it. And then we also have in the newsletter articles about creating multiple streams of income, precious metals, annuities, agricultural commodities, options and stock trading, emerging market investing, small business ideas, retirement income strategies, energy investing, international real estate. We're moving in all of these areas. If this stuff is interesting to you, invest in yourself, invest in your education, and pick up a copy of this newsletter. Our subscriber base has exploded this year, and we are doing everything we can to create very solid information for you. I hope that you can see from all the things that we do on a daily, a weekly, and a monthly basis that we're desiring to educate you and equip you to help you so you can understand what's happening and what's getting ready to happen, so you can protect yourself, you can protect your finances, you can protect your faith, and you can protect your family. Protecting your faith is important. Those of you who are believers, who are followers of Christ, you know, it may sound funny that you're actually wanting to learn about this. You may say, well, what does that have to do with my faith? It has a lot of things to do with your faith, because we're called to be good stewards. And I tell you what, right now in the middle of all this malaise that we're in, it's very challenging to be a good steward. That's one of the things we're committed to here. We are conservative. We are not here to promote anything that is outrageous. We're not going to give you all kinds of risky ideas, but we are going to tell you what we understand. And we're going to share that with you each and every week on our program, each and every day on our site, each and every month here on these free webinars, and each and every quarter in our subscriber-only newsletter. And you can pick that up currently for only $129. That price will be going up in the middle of May. You currently get a signed copy of our best-selling book, Bankruptcy of Our Nation, which contains 12 key strategies for protecting yourself in these uncertain times. And you also get the newsletter and access to the portfolio with buy-sell alerts emailed to you each and every time we make a transaction. Okay, $129. You can buy that on FTMDaily.com. All right, let's talk about palladium. We're going to talk about palladium just for a minute. Here is a chart showing a 2-year chart of palladium. Tom, you've made some pretty darn good calls on this. We look at this 2-year chart and see that it could have been bought for $212 back in about 2 years ago, this same time period. Now we're closing in on what is it, about $750 recently? Is that where we're about right now?
Yeah, we're up there right around 760, somewhere in that area, and we expect it to be well over 900 by the end of the year. But of all the metals we've talked about, it has a little seasonality to it. It usually makes its run from the middle of August up through January or February. Then when they're not using it for the catalytic converter, we see it cool off. It's mined in the Soviet Union primarily. There's about 6 months they can mine a year, and about 6 months they can't. So we love this metal. I really think it's going to be $1,000 this year. Now, it is similar to silver in that it's an industrial metal first and an investment metal second. So as one of the callers asked questions earlier, it would apply to palladium. We got to pull back in the June, July time frame. You want to be ready to buy it. If you bought palladium every August 15th and sold it every February 15th the last 7 years, you would have made over 20% every single year, net to you. So there's one other thing. They put in an ETF last year. It's PALL, and it's helped stabilize the volatility. It doesn't go quite as volatile as it used to. So I think everybody should have palladium in their portfolio. I think you're going to see 900 to 1,000 for the years out, a good solid 20 to 25% higher than it is now. And I keep about 15% of my metal portfolio, not my whole portfolio, but of my metals portfolio. I like the number 10 to 20% of your metals being in palladium.
How about the rest of your portfolio, gold versus silver? You got 20%, 15%, 20% in palladium?
I think that's always going to be, I find the more the people that are really trying to, hit it hard and make up, and I think they're going to be more aggressive with the silver. A lot of my clients, and I probably fall into it too, I lean a lot more on gold because I know that any solution in the future is going to come through gold, and it's less volatile. Last year it went up 31%, while silver went up 83%, and over the 10 years, gold was still ahead of silver. But now this last move, the 4 months this year, silver now has gone slightly ahead of gold in overall performance over the 11-year period. So, everybody's a little different, but I'm about 50, 35, 15, 55, 30, 20, somewhere like that in my allocation. Gold the biggest, silver second, palladium third.
Okay, good answer. Okay, there's a question we get a lot here, and I want to address it briefly. Can I buy precious metals in my IRA? Tom, you have helped a lot of people move money into an IRA. And now I want to address this too, by the way. I just talked about IRAs and 401ks and tax-deferred plans, and I want to make sure that I help you understand something. One of the things that I'm concerned about are those who have all of their eggs in one basket. If every dime that you have is in a tax-deferred plan, that's not a good idea. That's not a good idea. So I want to make that one caveat. However, I do like tax-deferred plans because they have many benefits. However, note the difference. If you have all of your money in a tax-deferred plan, that's the difference. You don't want to have all of your money. You want to diversify your tax treatment just as you want to diversify your asset classes. So IRAs are fine. Just make sure that you don't have everything that you own locked up inside one. Okay, so can I buy precious metals in my IRA? Tom, talk to us about how somebody who's listening, who maybe has an old 401k that needs to be rolled over, or they have a current IRA that maybe they want to put precious metals into. And we're not talking about buying ETFs. We're talking about actually putting the physical metal inside the IRA. How does one go about doing that?
Well, there's about 15 approved custodians out there. The one that I like the best is SterlingTrustCompany.com. I do a lot of business with Gold Star. Those are my two favorites. You could look and see which one you like the best. But if you go to Sterling, that's STERLING, Trust Company, spelled all the way out.com. They have a self-directed precious metals IRA. So what you do is they're the custodian, and you download those forms, and you can do a transfer if you're moving it from like a bank and a CD. That's called a transfer. You're going to do a rollover, like if you had some money at Fidelity and you wanted to get part of it, then all you've got to be sure you do is, let's say you were going to move $20,000 from Fidelity to precious metals and physical precious metals, then you would just call Fidelity and tell them to liquidate $20,000 of whatever you were going to sell, because Sterling cannot take the stocks or bonds. It's got to come in as cash. Now, when you're filling those forms out to make the transfer to gold, silver, and palladium and platinum are all allowed, but there's only certain kinds that they got to be COMEX deliverable, and we can get into that later. But when you make that form, you're going to come to Section 8 and 9. And Section 8 is about whether or not you want somebody to get a copy of your statement every quarter. That could be your financial planner, your CPA, one of your children is going to look after your estate someday. That's Section 8. Section 9 is where you would call me as the broker, because you don't want them to assign you a broker. You want to call me, I'll give you my dealer information for them. We can talk about what you want. Once you get the account open, they charge you an account fee to open, and they charge you an annual storage fee, because it's against the law for you to hold the physical metal. It's got to be stored at Fidelity in Wilmington, Delaware. So they'll charge, I think it's $120 a year, up to $100,000 for the storage and the insurance. But you get a statement every quarter from them showing your value, and when you're ready to sell it or need a distribution, you call me, tell me how much you need, you give them the directive, and then we liquidate and send the money to Sterling, and they put it in your account and then send it out to you, and 1099 you own it as a distribution. So it's very simple to do. It's the fastest growing part, and definitely affects both gold and silver and palladium for the future, because these companies are growing like crazy as more and more people are diversifying and rolling out. Now, 401ks are very tough. A lot of them are set. You can't get money out of them. Even if you contributed part of it, the administrator won't let you do it. Some are more friendly and will let you roll out part of it to a self-directed IRA. But if you're dealing with a 401k, you should talk to the administrator of that plan before you start doing, a lot of work. And certainly if you were leaving a company or have already left the company, you can just liquidate it and put it into a self-directed IRA. But if you're still employed there, you may or may not be able to go into a self-directed IRA. But that's pretty much it, and that's a great way, because when I'm talking about investable money, You know, I'm talking about your IRA, your 401k, your savings, and I'm not talking about your car, your house, but as you come up with a percentage that you want to invest in precious metals, a lot of people do it strictly through their IRA. Others do it strictly through personal investment. Most people do some of both. But that does give you money to use to go into gold and silver that you ordinarily wouldn't have access to.
Okay, so if somebody has an IRA or an old 401k, you can actually walk them through the whole process from beginning, from step one.
Yeah, and Sterling has great questions and answers, and people that know more about setting it up than I do. They've got an 877 number you call. I had a lady tell me today how helpful they were, and she didn't have any idea how to do it, and they walked her through it, and she got it all set up, you know, in about 20 minutes with the help on the telephone. So they've got the help service and question and answer section. So it's got a lot of information on sterlingtrustcompany.com.
Okay, well, we're going to bring this recording to a close here in just a minute, and we're going to stay on for just a few minutes afterwards to answer all the questions that we have, so hold tight on the questions. Just real quickly before we close the webinar, I want to mention 5 common mistakes that new investors make. Tom, let's briefly treat these because we got to bring this to a close, and then we'll hang around for a few minutes and answer some questions. Number 1, common mistake for new investors. Being talked into buying the more expensive numismatic collector coins instead of simply buying the less expensive bullion coins and bars. That's certainly a common mistake that new investors make, Tom, isn't it?
Yeah, if you don't learn anything else from this webinar tonight, that's the most important. Numismatic coins have only gone up 186% for 10 years, where bullion coins have gone up 600%. And with the huge commissions that telemarketing firms charge, you just don't have a chance. You're buying the wrong product, and in my opinion, as these things get worse, those coins are even going to perform less. I mean, they'll go up with the amount of gold in them, but all the huge amount of premium that you pay for it is not going to go up. So I think you just, for most people, unless you're a collector and you enjoy that, then there's not a thing wrong with it. But even if you want to buy numismatic coins, I can sell them to you 30, 40% cheaper than you can buy them from these telemarketing firms.
Yeah, so if you do want numismatics, you can still sell them, but you certainly won't charge some of the prices that we see out there. I've heard some horror stories. I know you have too, obviously. Number 2, buying gold ETFs and then thinking that you own physical gold. Oh boy, that's another common mistake new investors make, because these ETFs are not really backed up by gold. They can't certainly sell that ETF and convert it to gold.
No, Andrew McGuire testified to that last summer in New York. He was a trader at GLD over in London, and they said they didn't have the gold to back it. They were buying future contracts to cover it, and that's okay. Price going up, but what happens is when people start pulling out at some point, if you're not one of the ones that get out first, there's no gold to sell. When you sell those contracts, that's not gold. And then you got to take delivery. There's no gold to get. So people just need to be careful. If they're traders, ETFs are fine. But if they're buying it, you know, for investment to hold, they much better off buying the physical and knowing they have it than taking a chance that the gold's not going to be there when they liquidate.
The other one is number 3, another common mistake, having unrealistic short-term expectations. Anybody who's bought in the last few months, you know, certainly is probably very surprised at the amount of return that they receive, especially on silver. But having unrealistic short-term expectations, you've got to remember gold and silver are just investments like everything else, even though they are very hot right now, and even though there's great fundamentals working for them. You should have a long-term mindset when you're buying precious metals. You shouldn't expect to make all your money, you know, in the first week.
I can't add to that. That says it all.
Number 4, buying from multiple dealers. This is kind of true in many different areas. Nothing wrong with shopping around. It's certainly very important to do that. But once you find somebody that you like and that it has a good price, it's best to do that and do mass volume with that particular person, whether it be with Tom or someone else, because that way you get the best bang for your buck.
Well, you do that too, and a lot of these companies take your name and sell it I would never sell an investor's name. I would never give anybody an investor's email. I had a fellow about 3 months ago, and he said, well, who he was dealing with would never do that. So I told him to call in and change his name and change his middle initial and see how long it took before he got a solicitation from somewhere. It took 3 weeks. They were selling his name to other companies and other products. You just got to be very careful and confidential, because the one thing I'll tell you from the bottom of my heart, I'm not doing this because I need the money. I'm doing this because God has put on my heart to help people during these troubled times, and there's not many people that think like that. I'm fortunate. I've had a great life and been successful, and but I'm telling you, most of them out there, it's not about you, it's about them, and that's unfortunate. So just be careful. If you know the dealer you're dealing with, that's great, but just be careful they're not selling your name or giving your email out to other people for solicitation.
Very important. And then number 5, knowing how much to invest. It's vital that you be sure that you approach this with a plan, that you have a game plan in place, that you're just not simply buying just based upon a whim, but you're actually sitting down and really thinking about this, planning it out, and making a educated and informed decision on how much to buy. And maybe even talking to your financial advisor or someone, a trusted advisor first, to make sure you're making the right decision. Now, when it comes to how to buy gold, we're going to bring this webinar to a conclusion, but before we do, I want to give Tom's contact information. He is available Monday through Friday, typically 8 to 5 Eastern time, because he's based out in Atlanta. Here's the information, how to buy gold in 5 easy steps, and this is basically how it works. Tom, correct me if any of these are wrong. First, you simply call Tom at 800-247-2812, or they can email you, Tom, right?
Yeah, tgcloud@bellsouth.net, and they can email me, request to be on my email blast list, which is completely confidential, and then everything else is right there to look at. And right now things are jammed, so I am hard to get a hold of. I had like 77 calls to return because I had to leave town for a day and a half last 2 days, but we're fixing all that. My daughter has got a PhD in economics. She's been teaching in college for 3 years. Is going to come and see if she likes my business starting in June. So I've got some help on the way. If y'all hang in there with us, we can get back to you quicker. But it has been a lot of calls coming in. I'm doing the best I can every day to get back to every call. But
I tell you what, Tom, I think I would rather call and get a voicemail with your voice on it than call a call center in a foreign country and have to talk to somebody about it. So it's great they get to talk to you directly. But maybe they should email you. Would that be a quicker response in some cases?
Yeah, I check the email every hour, and I try to stop 5 minutes and answer any quick questions or confirm if they want to order and say, go in and buy me X amount of. And that's not usually the first time, but after they've done business with us a few times, they'll just say, buy me 101 ounce silver rounds, and just let me confirm that you did. And so they can do that.
Okay, so they can call or email you. Then they decide with you which metals and forms of the metals, whether bars or coins, are best. You'll kind of guide them and kind of help them understand what might be the best deal at that time, because I know prices change occasionally. And for your specific financial situation, then you place your order and you lock in your price, and then you mail your funds in to Tom, and then he ships out the precious metals order within days of receiving your payment, and he throws in free insurance and free shipping on the entire order when you mention that you heard about him through us. That's all you got to do. Just say, hey, I heard about you on the webinar. He'll throw in free shipping and insurance on the entire order. Now, when you send out the precious metals, Tom, tell them how quick you're sending it out, because many companies, and I won't mention any names, it takes quite a long time to get those precious metals when you order.
Yeah, this one guy did a survey of 70 companies, and the average day from the day the investor check cleared the bank till they got it was 31 days. I ship it out the third day after we get the check, so our customers are getting it literally from the time the check cashes in less than a week.
Well, that's fantastic.
Most of the time. Now, there are some delays sometimes, but we've been very fortunate, not very often.
All right, well, I'm just going to run over this final list of 4 things, and then we're going to bring this webinar to a conclusion, and then we'll hang around for a few minutes and answer some questions off of the air. Number 1, this is what you should know. Holding physical metals is very important when it comes to precious metals. I hope you gained that tonight, that holding the physical metal itself is important. We didn't get into a lot of the reasons as to why that's important. We've gone into that in some other webinars and certainly on our broadcast each and every week. But holding physical metals is an important part of the process of investing in precious metals. Gold will perform well, and we expect silver to do even better. Of course, we do expect a lot of volatility as we go forward. Owning some supplemental gold mining stocks may be a good idea if you do your research. And I use that word supplemental because those can be highly risky. Of course, you're dependent upon good management. You're dependent upon good earnings. You're dependent upon them finding metal in the ground. And so there's all kinds of other variables and factors that come into play with mining stocks. But many of you do ask me about that. I do think it's a good supplement. Just be very, very careful. And number 4, beware of precious metals ETFs that invest in the futures market. Realize that they may be very good for short-term trading, but if you're wanting to get long-term inflation protection and you're wanting to hold them for that specific purpose and you don't trust the government, which I know many people are losing their trust, then ETFs are probably not your best bet. You're probably much better off holding the physical metal. So Tom, 800-247-2812. They can call you. They can also sign up for your email newsletter that you send out 2 or 3 times a week on our website at FTMDaily.com. And I want to thank you so much for your time tonight, and I appreciate you coming on.
Enjoyed it very much.